and everything going on right now.
Okay. And over the course of this time, I've watched your business develop. Now you guys are engaging as well. You're actively investing yourselves. You're not just serving the investor base. So now you're jumping into the active fray in a forum, and you're working with those that fix and flip and those that are buying and holding. But within your own experience right now, as you're engaging into, we were talking about this a little bit earlier, right? We're talking about what is the exit strategy approach. We've got many that just jump into the game, that I'm going to flip this house, but I'm not thinking about anything else. And what are the critical factors that we've got to look at?
Right. Well, you hit in the head. We're diversifying ourselves. We decided, it's not only just, yes, we're helping our clients, but we're also looking at how we can grow our business through the ownership of properties. But then we are very risk averse in some things. We focus on cash flow, rentals. We think that based on your very similar to your 40-40-20 approach. We think that we need to have that portion of the portfolio that is cash flowing on a monthly basis. So right now, for example, we are working on an acquisition of an apartment complex, where we initially, when we threw the numbers, like, okay, we're going to buy it and sell it within a couple of years. And then when we did the numbers, it makes more sense to keep it, and then, cash flow from that property and use that maybe as leverage for future acquisitions there. But then flips, we are a little bit unique in that we want flips that work as rentals. I think one of the big mistakes out there is that people get into real estate because they see HGTV, they see these shows, and they make it look so easy. But then their exit strategy is just one. Hey, I want to do this. And one thing that we predicate to our investors is you need to have plan A, plan B, plan C. For flips, for example, we look for flips that if something happens with the market going down, the wrong way, you can rent it and at least cover your costs. That's again, there are not a lot of them out there. Once you start getting into the high-end flips, it's hard to just justify a cap rate of 5 or 7. But if you get into that $100,000 to $500,000 range, you can find those flips that work as rentals. And again, you diversify because you can have those pure flips, where you bank on depreciation and the market, increasing. But then you can have those where you say, these ones, if they don't work, I can keep in my own rental portfolio and grow that. And we are huge proponents of growing your rental portfolio first and then getting into flips. So, we tell them, hey, try to get at least 10 rentals. Once you have 10 rentals, it's one of those self-feeding beasts,
Sure.
And then you can take the risk, again, back to your 40-40-20, then you can go to that 20 and say, let me swing for the fences. Because worst case scenario, I still have my fallback, I'm getting my monthly income, and it's producing, cash on a monthly basis that can support those high risk investments if you want at one point.